Good evening, everyone. Welcome to this live webinar. First of all, of course, Happy New Year and all the best for 2017. Nenad and I wish you lots of health, success, and great trading in this upcoming year. We're going to take a look actually at the forecast for 2017 from a financial markets point of view. What could we expect? We'll be taking a look at fundamentals and technical aspects for this year. And also a quick review of this year. That's where we're going to start, just to get a sentiment, kind of the vibe, what happened, and how that can continue into this year. First, though, be aware of this disclaimer, the fact that this webinar is shown to a global audience, but may not be suitable for everyone. Please go to admiralmarketsglobal.com, select your country of residence, and contact the appropriate entity to find out if this webinar is suitable for you. Plus, also be aware that trading for exchange and global financial markets is considered high risk. Please seek the advice of an independent financial advisor for more information on that. This webinar is for informational and educational purposes only. By continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, so Nenad and I are going to take a look at basically the key events of last year, what to expect from 2017, what tools we recommend, and some Q&A session if you like. By all means, feel free to use a hashtag at hashtag AMTrading or, of course, the chat in this box. Or you can look for the recording, of course, you can find at Admiral Markets YouTube channel. Alrighty, so, well, last year, very quick, just a few minutes here, because most of us, of course, already are aware of these things, but just to give a recap here. So the year, some geopolitical things that were dominant. Of course, a lot of things happened last year. So if it's not in this list, it doesn't mean it's not important. But obviously, one of the major things were that the Brexit, the UK choosing to leave the EU, the US elections, with Trump winning those unexpectedly, indicating basically an anti-establishment, maybe an anti-trade, anti-globalization mood. With the Brexit and Trump winning, one could definitely find some reasons for that kind of sentiment there. Thirdly, basically the Fed increasing the interest rate at the very last moment, just like in 2015. So back-to-back years that we had an increase rate. ECB actually going the opposite the last 2 years, so there's definitely some central bank divergence there. And of course, the Italian referendum and the potential EU, the troubles there in the European zone are continuing. All right, so from an economical and financial point of view, well, basically, trade and globalization is continuing. 2016 as the years before, it's getting more and more globalized, and perhaps that's also the political kind of backlash that we're seeing. In fact, there are certain trade agreements being negotiated between the U.S. and the Pacific countries, U.S. and the EU, but those are all not finalized. They're all in agreement, or they're being negotiated, I should say, at this moment. So those are some of the things that we're seeing at this point. We're seeing also, for instance, more EU countries applying, or countries applying to the EU. So this is the kind of trend that we saw continue in 2016. From a trading perspective, here you see a map, by the way, from the oil import and export at this moment, the balance. Well, basically, oil going down, your dollar going down, but also not much of a lot of movement there from a weekly perspective. From a monthly perspective, prices are going sideways. But still, if there's any direction, the euro dollar, of course, did make a nosedive in the last few months there of last year. All right, that's a quick overview. More importantly, though, and just give me 1 second. Sorry, folks, I just have a slight cold there. It's not bad, but I might need a few seconds pause. So, more importantly, what could we expect from 2017? So I think it could be quite a volatile and rocky 2017. I think that we saw already the kind of outline for that in 2016. I do think that could continue this year. There's a decent chance of that happening, maybe 3 out of 4 chance. Of course, nothing is 100% forecastable, especially if you look at an entire year, especially if you look at that many factors that can influence this year as well. This is always a bit difficult with forecasting. That's different with trading. Of course, trading, we're looking at typically a bit more short term. We're looking a bit not as far as ahead of time. We incorporate new information when we look at candles, of course. When you're doing forecasting, you can also update, of course, your forecast. But now we're doing a forecast for the entire 2017. So that's a decent period of time with a lot of political factors that could change things. But from our point of view, it could be quite a rocky 2017 from a political point of view. So be on guard for those major events. For instance, the elections in France, in Germany, in Holland, the Brexit process. Those are all things we want to be aware of and keep an eye on. So we want to be prepared for those. And there could be trading opportunities based on those, right? But for the moment, these events are kind of risk factors that are difficult to say. They are quite far ahead of time. I don't think there's anything specific trade yet connected to those. The earliest event that we have is Trump's inauguration, in fact, and Nenad and I will be releasing a special on that soon. So that's something we're going to be forecasting what we think that the dollar could do based on basically Trump's first 100 days. So that's probably the first thing that we could discuss. Regarding the other political events, that's something that probably will happen more in the second quarter, third quarter of this year. Regarding geopolitics, so we're going to be talking just a tad about politics and basically some economic trends first. Then we're going to move on and talk about some tools, and then we're going to talk about technical analysis and the trends we're expecting for this year. So bear with me if part of this political discussion is not for you. There's technical analysis coming up a bit later. So regarding politics, the first 100 days is always a bit of with any presidency in the U.S., it's always something that investors and the voters are kind of sitting on the sidelines trying to give a new president the space and time to find his new path. And so this probably will be again valid for Trump. Of course, there has been quite a, let's say, a dynamic, quite a change in maybe the way things played out during the political process last year in the U.S. It, of course, always has been a struggle, a big fight between two candidates. Last year, maybe a new era kind of kicked off in how the public sees the establishment and who is classified as establishment and anti-establishment. So from that point of view, also the internal politics between or amongst the Democrats and Republicans seem to be a bit more harsh, seem to be less negotiable between them. Consensus is difficult to find. So in the U.S., it seems to be a bumpy period of time for the next years, I would say, looking at the kind of struggle and battle between the Democrats and Republicans, between Trump and his own Republican Party that he had in the past, and that's not so actual at the moment. But it depends, of course, as well what Trump will push in his policies. Not all policies will be supported by necessarily automatically by all Republicans, so that could be a point of friction as well. Also, a point of friction could be Trump's popularity with the voters, something we have to keep an eye on as if you're interested in politics, and these politics could, of course, influence the economics and then also the currencies. Why? Because Trump was the most unpopular presidential candidate, in fact, that was chosen in U.S. history. All right, so he's going to try to flip that, trying to change that. I think that Trump will keep a keen eye on that. But ultimately, is he going to succeed? That's something that could be a friction point. We'll have to see how that plays out. in the next few months and years. And of course, Trump promoted himself as anti-establishment, all right, but his choices of cabinets have been the opposite, have not really resembled the anti-establishment kind of direction he seemed to go. With the choices he made so far, it doesn't resemble that. So that could also lead to some difficulties with the popularity, as mentioned just before. So there could be some friction there as well. So those are things to look at from a political point of view. Of course, it's going to be very important to keep an eye on his tax and economic plans, his infrastructure plan, how the U.S. debt handles itself, because infrastructure tax cuts do cost money, and the U.S. debt could increase. Of course, tax cuts and infrastructure investments could spur more tax revenue because those would be basically generating more money. But the tax department so far has said that that will have a hit on the debt, and there should be a debt increase despite the higher generated revenue. So these are things that we have to keep an eye on. Basically, an infrastructure plan, when I read about it, it would have been great a few years ago when the interest rates were low. Then the investment would not have crowded out, would not have replaced private investment. As the interest rates go up, there is a chance that public investment will crowd out private investment. So the timing is maybe less beneficial than a few years ago. But of course, infrastructure does give a long-term benefit. It brings the country to a higher level. So maybe not as fantastic as a few years ago, but could still be beneficial, could still create jobs, so could still be spur inflation and therefore create a higher interest rate, right? And create better economic conditions. So depends, of course, on the details, what kind of infrastructure plan, etc. And we have to keep an eye on how the sentiment towards anti-trade, anti-globalization will play out throughout the world and in the U.S. Now, quickly, so some things to keep an eye on as well. Basically, how that anti-sentiment basically impacts current trade deals, the NAFTA, future trade deals, international relations between U.S. and China, between U.S. and the European Union, between U.S. and Russia. With U.S. and Russia, maybe that could be a lifting of the ban, for instance, the sanctions. There could be maybe a bit of a defrosting of relations. But with China, maybe a stronger frosting, right? More colder relations. And ultimately, how will Trump respond to all these leaders, and how will this interaction handle itself, right? That depends. Trump, of course, has not been a political leader before. He's not worked in politics before. So it remains a question mark how he's going to handle these things as a politician, because he doesn't have a track record as a politician. So that obviously remains a question mark that time will tell how that will be filled in by himself in this regard. All right, central bank dominance and divergence. Quick note here is that basically we see monetary easing in Europe and Japan, for instance, but tightening in the US and potential more tightening in 2017. Last year, Nenad and I were skeptical about the number of rate increases that 2016 could have, and we were right. There was only one basically that occurred. 2017, it's going to be a tough story. I would, at this moment, put my money on 2. So June, and I would say again December. I don't think more. I think that's too ambitious, especially if you look at the trend of the world, which is monetary easing. I think it's going to be difficult for the U.S. to go very sturdily and heavily against that trend. I don't think that the Fed will want to rock the boat. I think that the recovery is slowly there, but not very strong. I don't see it heating up that quickly in this year yet. And of course, that depends also on tax plans and the infrastructure plans of Trump. That could change if all these things get green light and the economy starts to pick up pace. In that case, maybe a third is possible, who knows? But At this moment, I think it's more likely that a 2 is the, I would say, preferred average is my best guess at this moment, my best forecast at this point. Now, of course, the debt itself could start to rise. We don't know how that will impact the U.S. in later years, but this is in the midterm, so that's something that I think is not so relevant at this moment. But what is a danger is basically if the rate hike starts to go up too quickly, that could be a bit of a problem for debt in the U.S. Be more difficult to repay the debt. There is a decent amount of debt that is difficult to pay back if the interest rate is going up, so there'll be more defaults in the U.S. and emerging markets, and that could trigger basically more defaults, and there could be a bit of, you never know how that plays out, that default, and more defaults could lead to something we saw in 2008 when the mortgage market basically snowballed. So that, I think, is something the Fed wants to be probably a bit careful of, not to create kind of a debt bubble that starts to deflate slowly but surely, or maybe not even slowly, but if it reaches a sort of trigger point that it kind of accelerates. So that's something I think the Fed is going to walk a tight line, not to let the economy move too hot, but not to cool it down and put the emerging markets too much under pressure. Don't forget that emerging markets sometimes have the debt in US dollars, so if the interest rate goes up, it's more difficult for those emerging markets to pay back that debt. Same for internal market in US. Consumers might be more difficult for them to pay the debt back. So I think it's a tight rope that they have to walk upon, and that's not going to be easy, but they're going to have to find that balance. I think that's basically the optimal, probably the optimal course. If you see from an S&P point of view, if you see what basically contributed to the S&P rallies in the last expansions, most recently the last 4 years, we see a green bar here on the right. That green bar basically is the impact of monetary expansion. So the Fed here having the most impact on the S&P rally, 92%. And that's a lot more than the previous expansion. There it was dependent on growth of earnings, just like in 1983 and 1990. You can see that in that case, the earnings growth was the propeller of the S&P 500, and that's something we would expect, wouldn't we? Obviously, S&P 500, we would expect it to go up. If earnings are going up, if companies are doing better, logically, that eventually that will follow suit. The index will, the stocks will go up, and the index will follow. That is not so the case in the last 4 years. You see, it was more fueled by basically the very accommodative monetary policy that pushed money into the financial markets and pushed money into the S&P 500. So the monetary easing is stopping and the Fed goes into monetary tightening. Could that rock the boat of the S&P 500? Maybe, right? It was something that forecasters expected already last year in 2015 that the S&P 500 could crash or could make a large correction, but it hasn't. So why? Why is it not actually making that retracement? There was some sideways correction on the S&P 500, but nothing overly massive. And well, basically, there could be a couple of reasons here. You know, the institutions, there was really low interest rates all over the board. So if you wanted to try to make some good return on money, the stock market was the best way. Institutions, high net worth individuals were all going therefore to the stock market. So that was definitely some demand there. I would say let's say the middle class has not joined the stock market as yet, but they could soon. Maybe they'll start to shift their focus and rejoin. That could keep kind of the trend in go and keep it pushing up for at least the next few months, maybe the next few quarters. Also, if you look at interest rates, once they start to move up, normally you do expect the S&P 500, the stock markets not to do so well, but it's really not that urgent as long as interest rates stay below 5%. On the left, you see the correlation between the weekly stock returns and interest rates. All right, so you see on the left, the dotted orange line, as long as it stays above 5%, there's still a positive relationship. So that means that stock will, have a positive return if interest rates go up below 5% on average, or at least 4%. Above that, then there starts to be a negative impact on the stock market. So from that perspective, interest rate hikes could create dips on the S&P 500, right? But ultimately, probably would not change the trend. Of course, this could be the exception that confirms the rule, but historically speaking, not a big game changer. In fact, if it stays below the 4%. Of course, if it really starts to move up quickly and the rate hike pace starts to accelerate, I wouldn't want to, then that might change things and we could see some retracement on the S&P 500. I would think that at this moment, obviously, it's an uptrend, higher highs, higher lows. It seems that this will keep going for the next few months, but if we do get one more or two more rate hikes, there could be some retracement because of that interest rate. I do think that, of course, these graphs are, very interesting to see, and they give a lot of data. Especially the left one shows that from that point of view, there's not much to fear for the S&P 500. But if we take into account the uniqueness of the 2012-2016 rally, I would be a bit more cautious about automatically assuming S&P 500 continuation. I do think that any rate hike, especially if you get into 2, 3 from now, if you get above 1.5%, I think that could stop the price action to the upside, maybe get some bearish retracement. There's divergence as well. We'll be talking about that in the technical section as well later on. So some upside, but then be careful for these signals if it goes too fast here with the rate hike. Now, if it goes too slow, it might not be good either, because then earnings are not doing that well. If it goes too slow, because then the economy is not doing that well. So it seems like a moderate continuation seems to be the best. If it's too heated up, then inflation will go up and interest rate will go up. If it's too slow and too cold, if the market is not, if the economy is not moving forward, then the earnings growth will not improve, right? That could, of course, stimulate the next growth of the S&P 500 if basically the economy starts to push forward and we see basically consumption go up and the economy start to pick up even further. If it slows down, earnings growth will slow down, and we don't have the quantitative easing anymore, so that could stall the S&P 500 as well. So there's an upside and downside risk. Somewhere in that middle, there's a sweet spot that gives the highest chance of a further upside. So some other things that we basically can look at here for this year. I talked about the UK's Brexit process, of course. That's something to keep an eye on the pound as well. If it's very costly, if it's very difficult for the UK to leave, if the terms are not that beneficial, it could be obviously bearish for the pound. Elections in Europe, how would they play out? That's something to keep an eye on. Will anti-establishment politics and preferences of the electorate continue this year? That could have a bearish impact on the euro. How will the economic performance in the Eurozone handle itself? Will there be some difficulties for the Eurozone to keep the Eurozone intact? Will there be some split of the Eurozone? So that's something to keep an eye on. Besides the Eurozone, some things to keep an eye on, of course, international relations between U.S. and Russia, between basically, of course, the world players in Syria, India. Can they continue with their restructuring of the economy to move forward? Can China go as well from a export country to more consumption-oriented country? How are they going to handle their debt and restructuring of the economy? So there are some factors here that I think could make 2017 a volatile year. Not necessarily all of these things have to play out, have to be impacting the market, but these are things that you want to keep an eye on and keep up to date with our webinars as we basically take it step by step throughout the weeks and months. But this is just a kind of a heads up what we can expect and what's important to keep an eye on from a political point of view. And that, of course, will impact the currencies as well. For instance, as Nenad will talk about in just a second, I think, is that, for instance, if Russia, the ban on Russia is lifted, that should be positive for the ruble, for instance, right? The Russian ruble. This is how there's an interplay in interaction between politics, economics, inflation, interest rates, currencies, trade, etc. Right? So anti-trade sentiment, for instance, could push gold up higher as a method of insecurity. As the world gets more insecure, gold is often seen as a safe haven, for instance. All right, so these trends are very important, and they could see accelerations perhaps this year. I mean, if I have to make a forecast, I think that my bet is 2017 will be a pretty bumpy year. In fact, I think that 2016 really changed the dynamics. We saw forecasters really being caught off guard with the Brexit and the Trump win. I think that new forecasts will have to take into account the changed perspective of anti-establishment, anti-trade, anti-globalization kind of sentiment that is growing, and it will try to surface, I think, in more places. How strong that trend is and how far it will push, I think those are the two main questions for this year, and we'll have to see how that develops. There could be, of course, eventually, if things, if that pushes far this year, maybe there will be an anti-reaction against this trend in 2018. But that's, again, a new topic for next year. From an industry-specific point of view, Nenad and I wanted to just give you some updates of what we can expect for this year. Something about the leverage might be a news event you want to keep an eye on. The regulations could be tightened there. There could be an impact on the industry. So that might change, in fact. So something to be aware of. Nenad might want to add something to that. Let's see if he's already with us now. Other than that, of course, we appreciated the UK award that we received last year. That's great for the best educational broker. We really appreciate it a lot. That was great stuff. That was 2016. Hopefully 2017 will give a similar result. All right, let's see if Nenad is on board with us.
Yes, hi Chris and hi everyone. I'm here, so yeah, I will proceed with industry specifics. So as you know, guys, there were some rumors and some real stuff about FCA changing regulation. So the thing is that we might see some changes in the industry soon, but definitely whatever it happens, it will be beneficial to you, so you don't need to worry about. The thing is that, well, according to their own observations, a lot of traders, the majority of traders are losing money. Now, when I started to trade back in 2006-07, I remember there were some talks that 5% of traders are actually successful in trading. So only 5% of traders. Today, the margin is higher. So latest information that I is like maybe 15 to 20%. So in my own opinion, they shouldn't do it. I mean, I have my own opinion, of course, always. So I don't think that is a smart move that will save other traders from over leveraging or over trading. Basically, guys, if you know how to trade, and I'm sure that you have learned a lot so far with Chris and me, being here with you also, we always state how we trade with lower leverage, with low risk. So you might know that they won't be doing anything with these regulations. So leverage might drop, but if you still trade with low risk, it won't have a big impact on your account. Now still 1 to 50 will be a good leverage, so for all traders who want additional leverage, we still need to see whether it will be applied as a rule, whether it will be official rule for UK, for UK FCA regulated brokers. So we still need to see if it will be applied. In next couple of months, we will see if that is the case. Leverage 1 to 25 is only for beginner traders. So all experienced traders and current traders will have a possibility to leverage up to 1 to 50. But rest assured that Admiral Markets is also offering a great deal here for all traders, no matter whether they're new or old traders. They offer a new margining model with leverage on major CFDs increased. So guys, we all who trade with Admiral Markets, including Chris and I, will enjoy new leverage trading, new things starting from January 9th. Here you can see everything. Just go to news page. Here, news, and you will find this headline, and you can read what it means in Forex. So this will be definitely beneficial to all traders. Okay, so this is a preemptive move before FCA does anything. This is what Admiral Markets offers, and this is actually very, very good in my own opinion. Okay, so leverage will be changed. Instead of having the overall leverage that changes, the thing is that this is important. Margin value of current position will no longer increase, okay, once your balance reaches another tier, okay? So you will be in full control of the leverage rate. It will depend on currencies itself. So this is actually a great thing, and I really appreciate this new thing, and it will help, of course, traders a lot. Of course, guys, as I said, we will start with live trading from mid-February. Yeah, from mid-February we will start with live trading, and still session recaps will persist. We will have session recaps on Monday. Okay, that is also a form of live trading in its own sense, and also we will have, as you know, we will have that live trading on every Wednesday during active sessions. We will try to capture some moves during live sessions. If we don't capture it, we will make pending orders. So that will be very interesting. Also, guys, you can check good reviews on Forex Peace Army here. Okay, we have very nice reviews here, and I hope that it will be also in 2017. Nominations, a lot of things happening. I and Chris and Admiral Markets are exclusive providers of analysis to Forex 3 2016, and we've been nominated for Forex Best Awards, also for Best Speaker, and so on. We were attending a lot of shows, a lot of seminars. I hope, guys, that we will also have seminars in your countries, and we are really looking forward to it. So yeah, I mean, there is a lot of good things going on. Also, there will be new tools to trade. If you still don't know about volatility protection setting, this is something very new. Okay, this is a part of Supreme Edition, and volatility protection, you can actually activate it on your charts. Volatility protection settings should actually protect your account from huge moves, okay, from huge moves. And the thing is that one of the options that VPS or volatility protection settings allow is to set up trades that will not be triggered if spread widens. Then you will have the ability to enter market with limited risk, okay. you should have a protection from instant losses on limit orders with predefined stop loss levels triggered on the same tick. Also, there will be an ability and the tool to minimize the market risk associated with stop orders, because you will be able to cancel stop orders on price gaps. Okay. Also, there will be a chance to avoid activation of the stop orders due to widened spreads during economic news releases. Okay, the ability to monitor the amount of slippage size that is applied to executed orders, and of course the ability to trade limit orders of larger scale due to partial fill functionality. Okay, that applies to less liquid markets when liquidity is low. So this should really save you in high volatility or thin liquidity where spikes are huge. So please check it. Okay, you can find also information on Armor Markets website. So this is also a great thing. I really don't need to mention how MT4 Supreme Edition is important. I mean, MT4 Supreme Edition has a lot of useful features. Chris and I already did a couple of webinars on MT4 Supreme. My favorite indicator is correlation matrix that gives nice correlation chart to your existing MT4. Also, you have alarms, you have trend line alarms, price alarms, you have range bar, you have also a great mini charts, inside charts. So this is actually added functionality to MT4. So it should definitely help your trading decisions and help your trading overall. Okay, so it's a very, very good thing to have. You can also limit your risk. Okay, you can put the amount of risk as you want to use. So actually you can limit your risk not to be above 5% of risk, because guys, I've been always telling you, as long as your risk, your daily risk is below 5%, you should be okay. As soon as you cross 5%, your account is in danger zone. Okay, so try to keep your account below 5% of risk threshold. It's very, very important. Okay, lot size also, you're able to control lot size in accordance to amount of pips. Okay, and also you can put manually how much profit in pips you want to take. So a lot of really useful tools, and that will continue in 2017. Okay, these are two examples what happened during Brexit. Okay, and well, here you can see that how volatility protection settings can actually protect you. These are gaps and orders not entered due to slippage setting. Okay, so that is how it can protect your account. So new in 2017 for our Forex education, of course, is a lot of new webinars with live trading on Wednesdays, pre-fact analysis as we always do, live training session, blogs, new blogs, interesting blogs, of course, about, you will see, okay, you will see soon. And definitely we will be always providing you up-to-date information on various tools, okay? Including technical way, fundamental, session recap, price action trading school, and risk management lessons that are very, very important. What I expect in 2017 regarding markets, I already said that I expect strength in first quarter of 2017, and we have actually witnessed the initial strength of dollar, especially after New Year. That was a huge spike in dollar yen, a huge drop in euro dollar, guys. I mean, we already expected it, but now today we had a bad ADP. I mean, these are all news that are basically not shaping a bigger trend, but generally in 2017, now I'm speaking for a longer term perspective, I expect a dollar strength. Really there should be some rate hikes. If you followed my Twitter yesterday, I mentioned even before FOMC that there will be additional rate hikes, because I saw that US Treasuries expanded, yields have been increasing, and that is all a signal for a rate hike. So I expect dollar strength generally, okay, in first quarter also. So I think that buying the dip in dollar yen will be possible. Dollar strength, of course, with corrections will persist in 2017. So I particularly think about dollar yen strength. Dollar ruble is well, currently we will also see. Let's start with dollar yen. Okay, so let's start with dollar yen. As I said, dollar yen is currently, guys, in a correction mode, and here you can see that actually dollar yen on daily is having a nice correction. Here, this is M pattern. Now it's at support, but stronger support, of course, is 115. That is a strong psychological level. So below that, we can expect 114.40. But this is short-term perspective, okay? This candle is important. This is M. Some people call this pattern Batman because, okay, you can actually place a Batman ears like this. So this is definitely bearish pattern started from this spot on. And even though, guys, look, I mean, this is the daily chart. Watch this, guys. This is ascending scallop here. You see, J-shaped pattern. So this pattern is called ascending scallop, like this. Okay, see, J. So I mean, this is still big, like on dollar yen. So I mean, even though we should expect some correction, right? Because even though if the pair drops down, it will still be supported here on these levels. I think that this is a big support, 113.00. So this should be a good support here. It's also L4 from monthly pivot point perspective. So even if it drops there, it will still be bought, in my opinion. So this is still, guys, dollar strength. Now from intraday perspective, guys, from intraday perspective, it's weakening, of course. You see, this is intraday. But from daily perspective, this is correction. So this is support. If it breaks, let's see if this level gets hit. I think I will place a pending buy order here because this is very strong level here. Also, I mentioned dollar ruble. Dollar ruble is also pair that you should watch in 2017, guys, because of U.S. sanctions that are imposed on Russia. Okay, we had actually, you see, dollar drop down. I think this is because of Trump, of course. Ruble went up, and that is because the market expects sanctions to be lifted. Okay, so we will see if that will happen. I personally expect that the sanctions could be lifted in 6 to 12 months. It's my opinion. So let's see what will happen. But definitely market is pricing in now some strength in ruble. Okay, and dollar ruble, you see, it's going down. So dollar is going down, ruble is going up. So dollar ruble currency pair, because this is base currency, it is going down. Still, we need to see what will happen if sanctions are lifted. Guys, this is head and shoulders pattern on weekly time frame. So if sanctions are lifted, it should be maybe the trade of the year if it happens. So I will be paying close attention to dollar ruble. Okay, it's ruble. So dollar ruble, and we will see if actually that will happen. Dollar Swiss, of course, there is a counterpart to euro dollar. Always watch euro dollar or dollar Swissy, okay, because those two pairs, I expect those two pairs to proceed in different ways. They have negative correlation, so dollar Swissy, pay attention to that. Pay attention to dollar Mexican peso, and of course, as I said on previous webinar, dollar Chinese yuan, guys, Chinese yuan or USD SHN or SNH, let's see. I will be paying close attention to that pair because it moves a lot. Let me see where it is now. I have marked it to follow it in 2017. I might do an occasional analysis, of course, on that pair, because for me it's very interesting to observe the price action. Let me see if I have it here. Should be somewhere. Okay, I have all pairs here. So let's see. Dollar yen. Yeah, I don't see it here, but I will try to find it definitely. I have it on my other account. I think ECN account has it, but let's, yes, here it is. Yeah, here, guys. Okay, you see, I mean, the range is huge. Okay, the range is huge. Today, okay, on this week, you see the pair made almost 2,000 pips. And now on 1 hour time frame, guys, watch this. I was telling you about dollar, Chinese yuan, guys. This pair is the beast. Okay, this is the beast. And definitely pay attention to this pair. I knew it should proceed down. Now the question was only whether it will retrace here, but it definitely dropped. So I was telling you about this pair, and I will probably follow it. I mean, I'm following it, but I will probably do analysis on it. It's very interesting for me to pay attention to, and definitely is a pair that makes a lot of pips if you are in the right side of the market. Okay. So yes, I expect euro weakness to proceed. This is just correction. Corrections are normal in Forex market. If we see on daily time frame, if we see move above 1.0620, a daily close about 1.620, then I think, guys, we might see a deeper correction, okay, in euro dollar. But at this point, guys, this is V-shaped reversal, dollar weakness, and ADP, bad ADP, spiked the pair to the upside. Today I did the analysis, so the first rejection from POC zone was good for like 40 pips, but then when pair came actually to POC number 2, you see it's currently just slightly in the zone, POC 2. It's very close to the zone, slightly above the zone, but I don't want to see, I mean, not I, but bears don't want to see 1.0620. Of course, if we see a daily above that level, that will invalidate my setup for short trades, definitely. So unless this level is taken out on daily close above it, bears still have control. Although bears are weakened, especially because market is expecting worse NFP based on ADP results. Overall, I expect bearish trend in the euro dollar to continue, guys. We should see some corrections in order to sell higher, of course, but generally trend would probably remain the same. Okay, also this is important. Don't forget about Japanese yen weakness. Generally, as I say, intraday trading is different beast than general trend. Pound yen, you see, pound was going down on weekly. It means that yen was going up. But well, guys, Bank of Japan simply does not like strong yen. So we might be seeing yen depreciation. Okay, they don't like strong yen, so we will see if there will be some interventions. GBP will continue to be volatile. Brexit talks will continue. Let's see if the article and when the Article 50 is announced. I mean, GBP dollar might make a new lower low then bounce. You see, guys, this is a zigzag. So this is high, a low, a lower high, lower low. So another push to the upside and another down. Generally speaking, I'm not speaking from giving you any signals, cues, or intraday analysis. This is generally, guys, this is weekly time frame. So we might see some spikes in pound dollar towards 28, guys. This is order block here. So let's see if it happens. I think there could be also short opportunities, but generally, guys, generally speaking, this is very strong downtrend. So if we see a correction, well, it will still be in downtrend, okay, especially because of Brexit talks and such. Ruble, okay, I already mentioned ruble. Pay attention to Swiss yen also, Australian dollar New Zealand, and dollar Norwegian crown. Australian dollar New Zealand is also very important pair. If you remember my analysis, guys, I was telling you, and I'm still defending my views, this should be bought on dips because Australian economy is stronger than New Zealand. Both are stable economies, but the price of Australian dollar New Zealand is good to trade because usually the price is in equilibrium. Whenever the pair drops, it's bought on dips. So should Australian dollar New Zealand drop here, I would be buying it. If it drops there, I would be buying that. So that is very important for you to know. Australian dollar New Zealand generally speaking is buy on dips, guys, okay, buy on dips, okay. And of course there are also different pairs and instruments to trade. We will talk about gold just in a second. For all of you guys who want to trade some let's say exclusive or exotic currencies, ECN account also has good and exotic currencies. I would be paying attention from time to time. Well, this is not so exotic, but as I said, it's a bit interesting to follow. You watch this. This is Swiss yen, and well, we might see some also continuation on downtrend. But you see here, actually, yen is being weakened by Swissy because starting from 23rd of 2016, 23rd of October 2016, this pair, Swiss yen, has been making constantly higher highs. So you see how yen has been weakening versus Swissy. So let's see if this will proceed, or now the correction, I mean the new trend movement might be to the downside. So Swiss yen is also interesting pair to trade, and I might be covering that pair also. Gold market, guys, in 2016, gold, well, you see gold weekly, it's not that good. In 2016, we saw a big spike, then it started to weaken. And here, guys, gold, I mean, guys, central banks' behavior in regard to gold has been fundamentally shifting over the past few years because there were slowing sales from European central banks, and also there were large purchases of gold from some emerging countries in Latin America, Middle East, and Asia. Usually we didn't see that in 2010 and 2000 up to 2015, central banks have not been net buyers of gold, and their demand has been expanding rapidly, okay. So because gold is always playing a role in reserve asset management, it's appreciated as one of the few assets that is universally permitted by investment guidelines of the world central banks. Okay, so it's deep and liquid market, and all reserve asset managers require that key characteristics of gold market. So we will see what will happen. Currently, gold is having a slight correction, but generally, guys, this is weekly is in downtrend. Okay, this trend line has been broken. Okay, also this trend line has been broken too. So you see, guys, we have generally downtrend. So when it hits this level, if it hits, probably we will see more downside reaction. Monthly still looks like it could go to the upside, but with this price pattern you never know what might happen, because if it goes down, this will be a failed inverted head and shoulders or bearish SHS, shoulder head shoulder pattern. This is actually bullish now, but if it fails, it will make a bearish movement to the downside. So we need definitely to go with technical levels for gold. Okay, as I said, central bank policies will influence gold always. There has been a search for alternative. One of alternatives to currencies and gold is Bitcoin, guys. Bitcoin is a cryptocurrency, and really it appreciates a lot in the market, and I think that Bitcoin will be stronger in 2017. According to monthly chart that I have already presented you, this should be a bounce in gold. But if this level is taken down, okay, I'm sure that there will be a huge drop. Now it's at the bottom of the shoulder, right shoulder, so shoulder, head, shoulder, inverted. This is bullish, so the bottom of right shoulder, and definitely we could see some spikes in gold that also can boost euro dollar to the upside as a part of correction. Stock indices, okay, S&P was in uptrend. Don't forget that Japanese yen is having a strong correlation with yen pairs. I still encourage you to watch Japanese yen correlation with China and yen, Nikkei and ASX 200. Watch DAX also and yen movement, because DAX and yen are also correlated. Let's say the DAX is going down, the Australian dollar yen would go down. If Japanese yen is going down, dollar yen is also going down. I expect this trend to continue in 2017. Also, guys, Hang Seng Index, I was telling you also to pay attention to Hang Seng Index. This is Hang Seng. It's very, very fast, guys. For all of you who want to trade with excitement and with emotional I can say emotional flux, this is the pair for you to trade. It's not the pair, this is the equity, the index for you to trade. Guys, this is the dragon also. This is the strongest of the strongest. Sometimes during Asian session it can make 800 to 1000 pips of movement. So if you are with a strong heart and you want to feel some excitement, trade HSI 50 Hang Seng Index. It's very, very good mover, so pay attention to it. Okay, so guys, this was everything. If you have anything to ask, just go ahead. We are at your disposal. We will help you. Tomorrow I will do a new analysis before NFP. I might post a pre-NFP setup on euro dollar or dollar yen. And depending on daily close after NFP, I will reassess my analysis and will show you on session recap on Monday. Sign up for session recap, guys. It's very important for you to know that this will be our first session recap in 2017. So go to education, webinars, and here, session recap. Okay, just join webinar on January. So we will make new pips, hopefully tomorrow and from Monday on. Today I didn't like particularly euro dollar movement a lot because it went to POC, but if it breaks 1.620, well, my short setup will be invalidated. So for all of you who are in my euro dollar setup trade, your stop should be at 1.0620. Go with 2% of risk, not higher than that. And let's see what NFP will bring us. Thank you guys for listening to me. We will be here with you soon. Cheers, and as always, trade safe.